The world just woke up to a financial tremor that most people will completely miss today, but history will not. While headlines are busy chasing noise, something far more dangerous has quietly moved in Japan. And once you understand what just happened, the idea of a $4 trillion market crash won't sound dramatic at all. It will sound overdue. This is not a theory, not a prediction pulled out of thin air, and not a panic play for clicks. This is about structure, leverage, timing, and a single decision that may have just pulled the pin on the global financial grenade everyone has been pretending isn't there. Right now, markets look calm on the surface. Indexes are still trading, analysts are still smiling on TV, and retail investors are still being told to stay invested for the long term. But underneath that calm is a fault line that has been building pressure for more than a decade, and Japan sits directly on top of it. To understand why this matters so much, you need to forget the way mainstream finance explains risk and start thinking about the system the way insiders do. Not as individual markets, but as one massive interconnected machine where Japan plays a role far bigger than its shrinking population or slow GDP growth would suggest. Japan is not just another economy. Japan is the backbone of global liquidity. For decades, it has been the cheapest source of money on earth. Zero rates, negative rates, endless bond buying. This turned Japan into the engine behind one of the most powerful and dangerous financial mechanisms ever created, the global carry trade. Investors, banks, hedge funds, and even governments borrowed trillions in cheap Japanese yen and sent that money into stocks, bonds, real estate, tech, crypto, emerging markets, and anything that promised a higher return. This wasn't a side strategy, this was the strategy. As long as Japan kept rates near zero and flooded the system with liquidity, this machine worked. Markets rose, volatility stayed low, and risk felt almost fake. Losses were temporary, dips were bought. The assumption became universal. Liquidity would always be there, Japan would always be there. But that assumption may have just died. What changed is not a single headline, but a shift in posture. A subtle but critical move that signals Japan is no longer willing to sacrifice its currency, its bond market, and its financial credibility just to keep global markets comfortable. When Japan steps back, the entire system feels it instantly, even if most people don't realize what they're seeing yet. The yen has been under extreme pressure. Years of ultra-loose policy turned it into a funding tool instead of a store of value. But now inflation, global rate divergence, and capital outflows have pushed Japan into a corner. Defend the currency and risk crashing asset markets, or protect markets and risk losing control of the currency. There is no painless option anymore. And when Japan makes even the smallest move toward defending the yen, it forces leveraged players around the world to react immediately. This is where the danger begins. The carry trade is not just large, it is massive, trillions of dollars massive. And it is built on leverage stacked on top of leverage. When the yen strengthens or funding costs rise, positions that once looked safe instantly become toxic. Investors don't slowly adjust. They rush. They unwind. They sell whatever they can, wherever they can, to cover funding costs and margin calls. This is how a move in Japan turns into selling pressure in U.S. stocks, European bonds, emerging markets, and even assets that appear completely unrelated on the surface. Liquidity doesn't disappear evenly. It vanishes violently. Think about what happens next. A hedge fund that borrowed yen to buy U.S. tech stocks suddenly faces rising costs. To reduce exposure, it sells stocks. Those sales push prices down. Falling prices trigger risk models, margin calls, and algorithmic selling. That selling forces other funds to de-risk. Banks tighten conditions. Credit spreads widen. What started as a currency issue turns into a liquidity event. And liquidity events are what crash markets, not bad news. Now layer in the timing. Global markets are already stretched. Valuations are elevated. Debt levels are extreme. Governments are running massive deficits. Central banks are trapped between inflation and instability. There is no cushion left. This system is fragile, not resilient. Japan's bond market adds another layer of risk that few people truly understand. The Japanese government bond market is one of the largest in the world, and it has been artificially supported for years through yield curve control. The central bank became the buyer of last resort, distorting price discovery and suppressing yields. This worked as long as inflation stayed low and confidence held. But once inflation enters the picture, that balance breaks. If yields rise too fast, bond prices fall. If bond prices fall, banks and institutions holding those bonds face losses. If confidence cracks, liquidity disappears. And because Japanese institutions are deeply connected to global markets, stress does not stay contained, it exports itself. This is why the phrase "Japan just pulled the trigger" matters. The trigger isn't a crash button, it's the release of pressure. It's the moment when the market realizes the safety net is no longer guaranteed. And markets hate uncertainty more than bad news. At the same time, the US and Europe are not in a position to absorb this shock easily. The Federal Reserve is dealing with inflation, political pressure, and credibility issues. It cannot simply cut rates aggressively without risking another inflation wave. Europe is struggling with growth, energy constraints, and debt sustainability. China is facing its own structural slowdown. There is no global firefighter standing by with unlimited water. This is how systemic events begin, not with a headline screaming crash, but with quiet stress in funding markets, currency volatility, and subtle changes in behavior. Liquidity dries up first at the edges, then in the core. Pay attention to what institutions do, not what they say. When volatility spikes unexpectedly, when correlations move toward one, when safe assets start moving together instead of offsetting each other. These are not random events, they are symptoms of a system under strain. A $4 trillion crash does not mean one single market collapses overnight. It means cumulative losses across equities, bonds, real estate, and risk assets as positions unwind and valuations compress. It means paper wealth evaporates. It means pensions, funds, and portfolios quietly take hits that take years to recover from. And it means retail investors are once again the last to understand what happened. The most dangerous part is that many people believe this time is different because of technology, innovation, or central bank tools. But the structure of leverage has not disappeared. It has grown. It has simply changed shape. And leverage always matters, no matter how advanced the story sounds. Japan's role in this story cannot be overstated. When the cheapest source of money in the world signals restraint, the entire global risk complex has to reprice. That repricing does not ask for permission. It does not wait for perfect explanations. It happens through forced selling, tightening conditions, and loss of confidence. Watch the currency markets. Watch funding spreads. Watch bond yields relative to risk assets. These are the early warning signals, and they are already flashing. This is not about fear, it is about awareness. The people who survive and even benefit from these periods are not the ones who panic, but the ones who understand where pressure is building before it releases. The goal is not to predict the exact day or hour, but to recognize the setup. Because once the unwind accelerates, narratives change fast. The same analysts who were bullish at the top will suddenly discover risks they ignored for years. The same strategies that always worked will fail at the same time. And the same investors who were told to hold through anything will be left wondering why no one warned them. Japan's move is not the end of the story. It is the beginning of a chain reaction. And chain reactions do not stop because people are uncomfortable with the implications. What happens next depends on how fast and how aggressively positions are forced to unwind, how policymakers respond, and whether confidence can be stabilized before selling feeds on itself. But one thing is already clear. The era of free, unlimited Japanese liquidity supporting global markets is ending. And when that pillar weakens, the structure above it has to adjust. The question is not whether markets will feel this. They already are. The question is how many people will recognize what they are seeing before the damage becomes obvious to everyone else. Because by the time it's obvious, the opportunity to prepare is already gone. And this is exactly how the biggest financial moves in history begin. As this pressure builds, the next layer to understand is how modern markets actually function when liquidity starts to retreat. Most people imagine markets as places where buyers and sellers meet freely, prices adjust smoothly, and value is discovered rationally. That is a comforting illusion. In reality, today's markets are dominated by flows, leverage, and automated responses. Price is often a side effect, not the driver. When liquidity is abundant, this structure feels stable. When liquidity tightens, it becomes brutally unforgiving. The global system is now optimized for cheap money, not for resilience. Risk models assume volatility stays within a narrow band. Portfolio construction assumes diversification will protect capital. Algorithms assume correlations will behave roughly as they have in the recent past. All of these assumptions quietly depend on one thing: continuous liquidity. Japan has been one of the largest silent providers of that liquidity, and as that support weakens, those assumptions begin to break down simultaneously. This is why early stages of systemic stress often look confusing. Markets may rally sharply one day and drop the next. Headlines will contradict price action. Commentators will argue whether moves are healthy corrections or buying opportunities. But under the surface, something more mechanical is happening. Balance sheets are being reassessed. Risk limits are being hit. Funding costs are being recalculated in real time. One of the first places this stress shows up is in volatility itself. Volatility is not just fear, it is the market's way of repricing uncertainty. When funding becomes less predictable, volatility rises. When volatility rises, leverage must fall. And when leverage falls, assets must be sold. This feedback loop is not emotional, it is structural. Consider how large institutions manage risk. They do not wait for news confirmation. They respond to metrics. Value at risk models, drawdown thresholds, and margin requirements force action. When volatility spikes or correlations increase, risk managers reduce exposure automatically. That means selling, regardless of conviction. And when many institutions follow similar models, they all move in the same direction at the same time. Japan's shift increases the probability of exactly this scenario. As the yen strengthens or funding costs rise, the math behind countless trades changes instantly. A position that looked profitable with cheap funding suddenly looks dangerous. The rational response is to exit, not to wait and hope. This pressure does not hit all assets equally at first. It targets the most crowded trades, the places where leverage is highest and assumptions are most complacent. High-growth equities, speculative tech, momentum-driven strategies, and illiquid assets are often first. But eventually, selling spreads. Even assets traditionally considered defensive can be sold to raise cash. This is where the idea of a multi-trillion-dollar crash becomes clearer. It is not about one dramatic collapse. It is about a broad repricing across asset classes. A few percentage points here, 10% there, 20% in the most stretched areas, added up across global markets, and the number becomes staggering. Another underestimated factor is currency hedging. Many global investors hedge their currency exposure using derivatives. When exchange rates move quickly, those hedges require adjustment. Adjustments require collateral. Collateral requires cash, and cash is raised by selling assets. This is another channel through which currency stress turns into asset market stress. Japan's importance here cannot be overstated. The yen is deeply embedded in global hedging strategies. Sudden moves force rapid adjustments, and those adjustments ripple outward. This is not theory. It has happened before, just on a smaller scale. The difference now is size, leverage, and timing. Timing is critical. The global economy is already slowing. Corporate margins are under pressure. Governments are issuing massive amounts of debt. Central banks are no longer expanding balance sheets aggressively. This means the shock absorbers that cushioned past crises are weaker or unavailable. In previous cycles, when stress emerged, central banks could cut rates quickly and inject liquidity without immediately triggering inflation concerns. Today, that option is constrained. Inflation has changed the rules. Cutting too aggressively risks undermining credibility and reigniting price pressures. Not cutting risks financial instability. Policymakers are trapped in a narrow corridor with very little room to maneuver. Markets sense this. Confidence is not just about numbers, it is about belief in the backstop. When investors believe central banks will step in decisively, risk-taking flourishes. When that belief weakens, caution replaces optimism. Japan's move challenges that belief directly. It signals that even the most accommodative central bank in modern history is reaching its limit. If Japan cannot maintain extreme policy indefinitely, who can? This is why narratives matter less than mechanics right now. You will hear arguments about productivity, innovation, artificial intelligence, demographic shifts, and long-term growth. These stories may be valid over decades, But liquidity operates on much shorter time frames. When funding tightens, long-term stories are ignored. Survival becomes the priority. Another critical aspect is how stress travels through the banking system. Banks are intermediaries. They provide funding, clear trades, and manage collateral. When volatility rises and asset prices fall, banks reassess counterparty risk. They demand more collateral. They reduce exposure. They pull back from marginal clients. This tightening amplifies stress. Even if banks themselves are better capitalized than in past crises, their behavior can still accelerate downturns. The system becomes more conservative at exactly the wrong time for leveraged participants. Forced deleveraging is rarely orderly. This is where psychology re-enters the picture. As losses accumulate and headlines turn negative, sentiment shifts. What was once dismissed as unlikely becomes plausible. What was once considered impossible becomes discussed openly. This shift in perception can be rapid and non-linear. Retail investors usually enter this phase late. They are conditioned to buy dips. They are told corrections are healthy. And often that advice works in liquidity-rich environments. But when the regime changes, old habits become dangerous. The market does not owe anyone a recovery on a convenient timeline. A key misunderstanding is believing that a crash requires a clear catalyst everyone agrees on. In reality, crashes often occur because of cascading reactions to stress, not a single event. Japan's action is not a headline shock, it is a pressure release that interacts with existing vulnerabilities. This is why experts who focus only on earnings or economic data may miss what is happening. Earnings can look fine right up until liquidity evaporates. Economic data can lag reality by months. Markets move first, explanations follow. Watch how different assets behave relative to each other. When bonds and stocks fall together, it signals something deeper than a simple growth scare. When currencies become volatile, it signals funding stress. When safe havens fail to protect portfolios, it signals a system-wide adjustment. Another overlooked factor is the role of passive investing. Index funds and ETFs now control a massive share of market flows. They are price-insensitive by design. Money flows in or out based on investor behavior, not valuation. In calm markets, this amplifies trends upward. In stressed markets, it accelerates declines. If outflows begin, ETFs sell underlying assets automatically. This creates additional pressure, especially in less liquid segments of the market. The selling is not strategic, it is mechanical, and mechanical selling does not stop because prices look attractive. Combine this with leverage, derivatives, and global interconnections, and you have a system prone to sharp, sudden moves once thresholds are crossed. Japan's shift increases the probability that those thresholds will be tested. This does not mean every market will collapse equally or simultaneously. There will be relative winners and losers. Cash becomes valuable, liquidity becomes valuable, flexibility becomes valuable, but broad risk exposure becomes dangerous. It is important to understand that markets do not need to break in a dramatic sense to cause serious damage. A prolonged period of volatility, drawdowns, and failed recoveries can be just as destructive to wealth and confidence. Time becomes the hidden cost. Investors who rely on steady compounding may find returns stagnating or reversing. Pension funds may struggle to meet assumptions. Governments may face higher borrowing costs. Corporations may delay investment. These second-order effects feed back into the economy, reinforcing the cycle. Japan's move is one of those inflection points that only becomes obvious in hindsight. Right now it feels abstract to many, but as effects propagate, clarity increases. By then, options narrow. The purpose of understanding this now is not to predict doom, but to recognize a regime shift. When the underlying rules change, strategies must adapt. What worked in a zero-rate, unlimited liquidity world may fail in a tightening, constraint-driven one. This is the uncomfortable reality markets are beginning to price in, not all at once, not cleanly, but persistently. And as this process unfolds, the next question becomes unavoidable. If liquidity is retreating and leverage must unwind, where does the pressure concentrate next, and who is most exposed when the system finally forces a reckoning? To answer that, you have to look at exposure, not the way marketing brochures present it, but the way balance sheets actually carry risk. Exposure is not just about what assets are owned. It is about how they are funded, how liquid they are, and how quickly they can be exited when conditions change. In periods like this, the weakest points are rarely obvious to the public until they fail. Start with sovereign debt. Governments around the world have become accustomed to borrowing cheaply and endlessly. Debt to GDP ratios that once would have triggered alarm are now treated as normal. This works as long as rates stay low and demand for bonds remains strong. But when liquidity tightens and funding costs rise, even large governments feel pressure. Japan itself is a warning sign here. It carries one of the highest debt burdens in the world, sustained only by ultra-loose policy. Any meaningful shift away from that policy sends a signal to other heavily indebted nations. The era of easy financing may be ending. When sovereign yields rise, everything reprices off them. Corporate borrowing costs increase, mortgage rates rise, equity valuations compress. This is how stress moves from financial markets into the real economy. It is slow at first, then sudden. Corporate debt is another major fault line. Years of cheap money encourage companies to borrow aggressively, often not to invest productively, but to buy back shares or acquire competitors. Balance sheets look fine when cash flows are strong and refinancing is easy. They look very different when rates rise and revenue slows. Downgrades follow, credit spreads widen, refinancing becomes more expensive or impossible. High-yield debt is particularly vulnerable. Investors chasing yield accepted lower compensation for risk for years. If defaults rise or liquidity dries up, that trade reverses quickly. Losses in credit markets can be severe and persistent, and they often spill into equities because many investors hold both. Real estate is another area of concern. Commercial real estate in particular faces a combination of higher rates, changing work patterns, and falling valuations. These assets are often highly leveraged and illiquid. When prices fall, refinancing becomes difficult. Forced sales follow. Banks exposed to this sector may tighten lending further, creating a negative feedback loop. Private markets add another layer of opacity. Private equity, private credit, and venture capital grew rapidly in the low-rate environment. Valuations were marked infrequently and often optimistically. Liquidity was assumed, not tested. In a stress scenario, these assets can become traps. Investors cannot exit easily, and reported values may lag reality. When those valuations eventually adjust, confidence takes a hit. Institutions that relied on private markets for returns may face funding gaps. Pension funds and endowments are particularly exposed here. Their obligations do not disappear just because markets fall. Now bring this back to Japan's role. Japanese institutions are deeply embedded across all these markets. Insurance companies, pension funds, and banks hold foreign bonds, equities, and alternative assets. When domestic conditions change, they may repatriate capital or reduce foreign exposure. That selling pressure affects global markets directly. At the same time, global investors who use Japanese funding must reduce risk. This creates a synchronized pullback. Capital flows reverse. Emerging markets, which often depend on foreign investment, feel the strain quickly. Currencies weaken. Inflation pressures rise. Central banks in those countries face impossible trade-offs. This is how a localized policy shift becomes a global event. Not because of intention, but because of interconnectedness. The system was built to optimize returns, not to isolate risk. Another factor that amplifies this process is narrative collapse. Markets run on stories as much as numbers. For years, the dominant story was that central banks had things under control, that liquidity would always be available in a crisis, and that diversification across assets would provide safety. When reality challenges that story, behavior changes. Once enough participants stop believing in the old narrative, prices adjust to reflect a new one, and new narratives tend to be harsher. Risk premiums rise, required returns increase. Assets that were priced for perfection must reprice for uncertainty. This does not require panic, it only requires reassessment. And reassessment, when done collectively, can look indistinguishable from panic in price terms. Technology accelerates this process. Information moves instantly. Trading is automated. Reactions that once took weeks now take minutes. This speed reduces the chance for gradual adjustment. Markets gap. Liquidity disappears at critical moments, stops are triggered, prices overshoot. This is why experienced market participants watch liquidity indicators more closely than headlines. They know that once liquidity is gone, fundamentals matter less in the short term. Survival becomes the goal. The idea of a $4 trillion market crash should be understood in this context. It is not a prediction of a single catastrophic day. It is a recognition that the scale of global exposure, leverage, and interconnectedness makes large cumulative losses plausible when a key pillar like Japanese liquidity weakens. $4 trillion is not an abstract number. It represents retirement savings, institutional capital, corporate valuations, and government balance sheets. It represents confidence built over years being tested in months or weeks. Importantly, this process creates both risk and opportunity. Periods of stress reset valuations. They expose weak business models. They reward patience and discipline. But they are unforgiving to complacency. Those who assume markets will quickly revert to the conditions of the last decade may find themselves repeatedly disappointed. Mean reversion works differently when the mean itself is shifting. This is where mindset matters. The goal is not to time the exact bottom or top. It is to avoid being structurally vulnerable to forced decisions. Liquidity is a form of optionality. So is flexibility. So is understanding how your exposure behaves under stress, not just in optimistic scenarios. Japan's action is a reminder that no policy regime lasts forever. Even the most extreme measures eventually meet constraints. When they do, markets must adapt. As this adaptation unfolds, volatility is not a sign of failure. It is a sign of transition. The old equilibrium is breaking down. A new one has not yet formed. Those who recognize this early can make informed choices. Those who ignore it may be forced to react later, under worse conditions. History shows that the most damaging losses often occur not because risks were unknowable, but because they were ignored while everything seemed fine. The warning signs were there, but they were inconvenient. Today's warning signs are not dramatic. They are technical, structural, and easy to dismiss, but they point in the same direction. The global financial system is adjusting to a world with tighter liquidity, higher uncertainty, and less tolerance for leverage. Japan's role in that adjustment is central, not peripheral. When the foundation shifts, the structure above it must respond. Markets are beginning to do exactly that. What comes next will not be determined by a single decision or a single institution, but by millions of interconnected responses to a new reality. And that reality is that the era of effortless liquidity is ending. The sooner that is understood, the more intelligently one can navigate what follows.